Hello and welcome back to the Express videos relevant for ACCA Paper P2. Remember to download the Express notes from our website at www.dxpgroup.com. In this video we will cover IAS 37, which deals with provision, contingent liabilities and contingent assets, and also IAS 12, which deals with taxation. Provision, it's a liability, but that liability is of uncertain timing or amount. Since it meets the definition of a liability, we will recognize the provision in the accounts if and only if three elements are present. There is a present obligation which arises from past events. That's a probable outflow of economic benefits from the company, and that outflow can be measured reliably. The present obligation can be constructive or legal, meaning it can be required by a law or a contract which I just signed, or it can come out from the operating policies of the entity. The initial valuation for provision is just the best estimate at year end. Okay, if it's one-off event, like I'm installing a server custom made for a customer and I want to book a provision for repair cost, I will take the most probable outcome and discount it if time value of money is material. For a series of events, let's assume the same warranty provision, but for electronics, for instance, this time, we will use the value of the outflow, expected outflow, and discount it again if the time value of money is material. Any change in valuation, like an increase in the provision or decrease in the provision, will be reflected directly in profit and loss of the company by booking an expense or crediting to income statement if we need to reduce the provision. With contingent liabilities, the contingent liability, either it's a possible obligation which will actually be confirmed by the occurrence and non-occurrence of one or more future events which are not under the control of the enterprise, or it can be a present obligation, but it's not probable that it will require an outflow to settle it, or the outflow cannot be measured reliably. The way we reflect contingent liabilities in financial statements is just disclosure by a note. A contingent asset is a possible asset which will again be confirmed by some future events which are not fully under the control of the entity. And with assets, we have to be virtually certain in order to actually book them into accounts. So if we are virtually certain that we will actually have some inflow of economic benefits, that is not a contingent asset. It's just a normal asset. Below you'll find a summary diagram on page 27 on the accounting treatment, if you want, for contingent liabilities in individual companies, which will give you points for discussion in P2 exam. So if we have basically a present obligation that results from a past event which requires a probable outflow of economic resources that can be measured reliably, that's a pure provision and we will include it into the accounts. We'll provide for it. If we have a present obligation arising from past event, but the possibility of an outflow of resources is actually not remote, we will just disclose it into the account. So it's possible that we might pay something, but it's not yet probable. And if that possibility is actually remote, we don't even disclose it. If we have a possible obligation and this obligation, it is probable actually to require an outflow of resources from the company, then we will disclose the contingent liability. If it's not probable, then we will do nothing. In short, if you want to use percentages, probable actually means a greater than 50% estimated possibility, possible between 5 but less than 50, remote is 5%, less than 5%, and a reliable estimate is just estimate which is more reliable than making no estimate in the vision of the standard. So basically, instead of pretending that we don't have any provisions to be booked, it is better to book our best estimate at year end. and provided means that we will actually include it at expected value and then discount it if is necessary into the accounts. IAS 12, taxation. This standard actually deals with both current and deferred tax. Current tax is the amount which is payable towards the tax authorities for the current year profits. That's an estimate at year end which will be booked in the P&L, and it will result actually by reference to the actual amount paid next year in an over or under provision each and every year. Deferred tax, if you want it in short, is just future tax. This arises on the transaction or on the gains that were booked into this accounting period, but they will become taxable using the tax rules in different accounting periods. Generally, it will be booked as a net liability. Occasionally, it may be an asset. If we have to book an asset in respect of deferred tax, make sure that we have enough temporary differences or enough future profits to actually offset the asset against. If we don't, in the foreseeable future, we do not book the asset because this is not virtually certain that we will actually benefit from this asset. The easiest way to calculate or to remember deferred tax is, first of all, to know the following definitions. What is the tax base of an asset or a liability? A tax base is actually the value that the asset or liability will have in the statement of financial position if instead of the IFRS rules we were using tax rules. So for an item of property, plant and equipment, we will be using capital allowances instead of depreciation. IFRS base is the base at the year end, or the valuation at the year end, for all the assets and liabilities in the statement of financial position. IAS 12 takes a statement of financial position approach. We will actually calculate deferred tax by reference between the difference between the IFRS base and the tax base of any assets and liabilities except the taxation at year end. Once we determine these differences, we have to decide which one are permanent and therefore which one are temporary. Permanent difference is not a phrase that is used in IAS 12, but it's actually helpful in illustrating the concept of deferred tax. A permanent difference arises whenever an income is never taxed for tax purposes or an expense is never allowable for tax purposes. For instance, fines or entertainment expenses, this will never be allowable for tax purposes. Income like grants or subsidies received from the government, those will never be taxed. Impairment of goodwill will always be a permanent difference. Deferred tax will actually arise only on temporary differences between the IFRS base and the tax base of any assets and liabilities. Key workings and methods to remember in the exam. We will have to calculate both the IFRS base and then the tax base for each asset and liability at the year end. You don't need to know any taxation rules, it will be presented to you in the exam. The difference between the two will be what we want to actually classify between temporary or permanent difference. In terms of property, for instance, we have an IFRS value of 10,000 with a tax base of 8, meaning the temporary difference between the two is 2,000. Multiply this with the tax rate. When we actually expect that difference to reverse, and that will give you a deferred tax liability at the year end. The same scenario is for software, and the other way around is for provision. So for provision, we have the IFRS value, but from the tax point of view, the tax base is 0. So the provisions are not an allowable expense if you want. For tax purposes, the expense will be allowable when we actually incur it. And therefore, the net effect, it will be presented as a net deferred tax liability at year end. The easiest way to remember this in the exam is the following. Go to the accounting policy and identify which assets and liabilities, okay, will actually lead with a difference between the IFRS base and the tax base. Some of these differences will be permanent, like goodwill arising on consolidation, government grants, business entertainment. State in the exam that this is a permanent difference and therefore it has no future tax effects. It will never be taxed or never be allowable for tax. Then for every difference other than the permanent one, meaning the temporary difference, we will calculate it at the year end and we multiply the result with the tax rate at the moment we expect the difference to reverse. We will look at all deferred tax assets that arise from this computation and we will look for evidence for impairment. What we mean by that, we have to make sure that we have sufficient taxable temporary differences in the future or sufficient profits in order to offset the deferred tax asset which is now recognized in the statement of financial position. Then we'll calculate the deferred tax liability and we'll charge it directly to the P&L. And if we have time in the exam, we will actually look at the temporary differences between the tax base and the IFRS base for the assets and liabilities and decide whether or not part of these gains or losses were actually booked in other comprehensive income, like for instance a revaluation reserve. And then we work out the deferred tax liability associated with this gain which was reported in other comprehensive income and we book it against equity reserves and we book it as a credit to P&L in order to adjust the expense that we just booked in the P&L. Remember, we will actually do this in the exam if and only if there is enough time for you to answer this question.